Welcome all subscribers to the Hard Right Edge. The Hard Right Edge is a free trader training short video that's included with your free subscription to the Inside Market Analysis bi-weekly webinar. This is Jeff Killian for the Inside Technician, and today's demonstration in this short video is the relative comparison of the money flow index, in this case the 14-period money flow index, right out of the box, right out of the Metastock professional program, as compared to a mark-to-the-market, updated, real-time, daily candlestick chart above here. Now, the money flow index sole purpose is to determine what is the reality behind the volume as compared to the prices, especially at turning points. Our goal as traders and investors is to determine high probability market turning points, and then from that determine what are the realities of its elongated future directional price movement. If we take a look at the S&P 500 index right here, again, we have a situation here where back on July 26, 2011, money flow, in this case, was not an official negative divergence. This peak as compared to this price point, and this peak as compared to this price point, because this price point was lower. However, there was a substantial divergence. And here, if we draw a trend line, we can see exactly what that was as compared to these prices that money, in fact, was leaving. Now, after that time, even if you had simply included a short-term trend line from here to here, okay, with a lower pivot point low as compared to here and a lot of weakness within this indicator, it would have given you the heads up to be flat or go short. In this case, big day down, market trades down for one of the biggest corrections in the most recent market history until it formed a new base formation here, and the money flow in fact turned back around and started to trade back up here. Now, money flow is a direct calculation of accumulation and distribution, but that is not just a calculation of any accumulation and distribution. It is the direct relationship of the distribution of the smart money players, as in here had sold off within this chart pattern long before prices had tanked. Accumulation here by smart money people coming back in is what drives the prices back up. This is one example on the S&P equities. Let's move forward in time. And let's take a good hard look at the shakeout area here as compared to the volatility involved in this chart pattern here. The base formation was made, almost a double bottom here, and here a shakeout before prices turned back up. Now, if we take a look at the money flow in isolation, in this case, we have a substantial divergence as compared to prices. Here, a base level, here, a lower level for the shakeout, but money flow itself is saying that there is a lot of pent-up buying pressure at this point right here, which was the catalyst that acted as the actionable intelligence for what the volume was really doing. These institutional people have a way, these smart money players have a way of trying to hide what they're doing so that they can make the lion's share of the money. It's our job to figure out what they're doing and when they're doing it so we can capitalize on these opportunities. Now, this is simply on the equity side. In a minute, we'll get into futures and take a look at that on the continuous contracts. But here, look what did happen out of this. Prices traded way up. Again, a forewarning for future directional price movement. This is the real value behind the money flow index. And again, this is right out of the box in the Metastock professional program. So let's go back and let's take a look at the continuous contracts on the futures, where the equities are the proxy for the futures. The futures will give us the opportunities on the E-mini side that we need. in order to be able to trade that market almost 24 hours a day versus just the equities on the open sessions on the U.S. equity side. Here, we have almost a replica, a little bit different, where no two chart patterns are ever the same, no two indicator formations are exactly the same. We have very similar showing of the substantial sell-off before the prices tanked. And again, this day is July 25th, 2011, before the market tanked for one of the biggest corrections in the most recent market history. Again, here to here, a substantial divergence showing us that here was the peak along with this pivot point high, and the money had sold off before the prices tanked. And what happened? It's almost exactly the same as the equity side, isn't it? Confluence traders and investors. One market against another, as against another, to be able to determine what is the reality of future directional price movement. Now, the way that we teach here, in a fully transparent environment, holding nothing back, is that you learn these indicators inside and out, especially this one, yes. And we have quite a few more in this arsenal of indicators that I trade with every single day, and I won't trade without this one because of the actionable intelligence it provides to me, meaning something that I can trade off of. Now, in this case, the money flow turned back around like it did on the equity side. So there's your confirmation. Here was your first confirmation. Here's your second to be long. Again, okay. Now prices are trading in this volatility-based chart pattern. And here we have a very similar situation, but not the same with the up closes here. But look at what the money flow says. Right here, again, a substantial positive divergence as compared to the prices right here at the critical market turning point, right here, with the two up closes, now confirmed to be long again on 10/6/2011 as compared to the prices. Obviously, we would want to fly in here, simple trend line here, and look for the violation, which comes right here. This is the type of showing, the kind of representation of an indicator versus the price action that can enable us as superior traders and investors to potentially weigh up the profitability. And this is really what we want, right? This is why we get up every morning at 1:30, 3:30, and 5:30 in the morning and hit the rubber, right? And make it happen, of course. Now, for any of you that are interested in this program, and again, none of the indicators that I use are any specially designed indicators. I have created many, but I have gone back to the most simplest indicators, the most time-tested, proven indicators, and back-tested them all out, and what I came up with was the simplest ones are the ones that work the best, that really quantify the direct relationship of supply and demand, who's in charge, when that changing of the guard is happening, and exactly where I need to be at the right place at the right time. So let's take a look at this. Here's the new home page with some of the most recent sponsorships, magazines that the Inside Technicians articles are seen in. The most recent are coming out in this month, May, this week, in SFO and Traders World magazine again. Here is where you can click through the Metastock live link right to Metastock's special deals. We have a contract with Metastock, and we have the lowest prices in the business. Traders and investors, if you're interested in this program, I would highly recommend you take a complete free trial if you want. If not, you can purchase the program here at the rock bottom prices. So again, thank you for joining me for your free trader training video, The Hard Right Edge. Any interest on any professional trader mentoring programs we have, you can call directly at 718-395-9347. Again, at 9347 and talk to me directly. Time is very limited. Space is very limited. So the only thing that I ask is that you are serious and know what you want and are prepared to make a commitment, because this is a direct commitment from myself to yourself in order to get you where you need to go. So I hope you've enjoyed the video, and we look forward to seeing you on the next Hard Right Edge Trader Training video. Good day.